Hey everybody, Randy Patrick here with Housing Bubble 2.0 news of the week, or as I like to say, another episode of As the Housing Market Turns. Today is February the 7th. A little bit of news, nothing too exciting to be up front with you here, so we'll get into it. Redfin, we know who Redfin is, obviously, stated the other day that West Coast is shifting to a buyer's market. So obviously, there's more inventory out there. Buyers are able to pick and choose a little bit, particularly in San Jose, Seattle, and Portland. It's taking longer to sell properties. And I guess their sentiment is that buyers don't have the same sense of urgency they had earlier in 2018. So if you recall, everything was in a frenzy. There was multiple offers for people. Everything was a bit of chaos, and sellers were sitting back and sort of, rubbing their hands together going, this is fantastic. Well, that has changed big time now, especially in the West Coast here. And, they're not worried about losing out on homes because we see more inventory coming on now. So that's a sign buyers are going, I'm going to wait. I'm going to take a look around. I'm not going to jump through hoops and have to overpay for things I shouldn't have to overpay on. They're willing to wait for the seller to drop their price. They're willing to put in lower offers and negotiate. And just to sort of as a sentiment on this is the fact that Realtor.com stated that 15% of all U.S. listings had a price cut in January. So there you go right there. That's a pretty good number across the board saying you got your home listed, nothing's happening, let's drop price, especially in January. Because typically January is a month where you would see an increase in listings. We don't want to list it over the holidays. We'll wait to the new year, so we have less days on market, it's fresher, etc. Well, we already see a significant amount of drop prices on listings in January. Interesting. Now, according to CoreLogic, home values rose at the slowest rate in more than 6 years. Prices rose in December 4.7% year over year. This is the smallest price gain since August of 2012. I would look at August of 2012 as being kind of like the trough of the market. We had the 2006 peak, 2011-12 was kind of the trough there before we started to come out of it and started to gain some appreciation. So smallest gains since August 2012. Now their comment though is that we still saw a gain. Prices are still rising because there still is some inventory shortage out there. Well, that's, I guess you could say, true. So December sales are probably based on October, September inventory, maybe a bit of November. So we're not seeing the effect of all the inventory that's come in on November and December and now in January. We're not going to see that until a bit later. So that's why the numbers are still a bit skewed as an increase. The forecast for 2019 is annual price growth of 3.4%. I'm thinking that's going to have to be changed and lowered as time goes on. We'll see some more of that information again as the next couple of months creep through. What this means, though, according to CoreLogic, is that there are less overvalued markets. So on the top 50 markets across the U.S., they deem that 40% are overvalued, 18% are actually undervalued, and 42% they consider to be at value. There's a calculation that they use. A market is considered to be overvalued if home prices are at least 10% above the long-term sustainable level. What that is, I'm not too sure. I suppose it's a forward-looking calculation based on historic trends. So again, they do have a way of, I guess you could say, analyzing and describing this. I'm not too sure exactly what it works out to be. Price reductions are now attributed to sellers overpricing their homes at the beginning of their sales cycle. So for example, in Denver, the sellers came out big time in January, but the buyers didn't decide to show up. January sales fell 30.8% from December to January. That's a pretty material big drop. It represented a 14.8% year-over-year decrease from January of this year to last year. And listings are up more than 52% from the same time last January. So we have more than half the inventory has been added in Denver for the month of January. Big time dollars there. So I mean, this says it all. Your inventory jumps 50%, your sales are down almost 31%, and your month to month, and you're almost 15% down year over year decrease as well. So, as I always say, This is not 2%, 3%, oh, a shift or slight correction. We're seeing bigger numbers here, which will lead to much greater price reductions and value dropping in the future. In Manhattan and Brooklyn, the luxury market's taken a big hit. Sales fell 28% in 2018. This is due to the large number of new homes and developments that were put on the marketplace. And I guess their comment is the new development market is slower to reduce prices and offer discounts. Now, I'm going to look at this as if you start looking at, a development phase here, well, you've bought the property probably in the peak. It takes you some time frame, to get the zoning and the due diligence done and the development done. By the time it's finished and put on the marketplace, you've burned a year, 2 years, etc. You've got a lot of money sunk into it. You're going to have to make a certain dollar value on the units and homes you're going to sell. And that was based on your numbers you probably did over a year ago. So you're not going to be as quick to drop them until you get more desperate, as far as I'm concerned. Now, the resale market is experiencing regular price reductions. That's been pretty robust, but apparently this new development, new home market's not doing quite the same thing, which means they're going to take a beating as time goes on. We are also starting to see the effects of what is referred to as SALT, state and local taxes. Those effects starting to come in now. I'm reading articles where people in various parts of the country, who used to get $3,000, $5,000, $9,000 refunds on their taxes are now actually having the reverse happen. They're having to pay. So as tax season approaches, we're going to see more and more people are going to come out and complain about this, saying, hey, it hasn't happened before. We always got refunds. Now we're seeing a payment, and we didn't budget for that, and we don't like it. Simple as that. High-cost areas like New York City and the tri-state area are already seeing wealthy people leave. So they are actually leaving or shifting their residence to other lower tax states. Basically, how's this going to affect those areas? Well, we're going to have tax revenue shortfalls, which at some point in time are also going to increase taxes or reduce expenditures on services and things like that the community gets. So, this is going to have an impact. A lot of the people who can afford to are moving out. They're changing their domicile. They're going to lower tax state locations where they're paying less, keeping more of their money. And also, when you're leaving some of these higher price locations, you're certainly getting a lot more bang for your buck when you purchase a property in lower tax areas. Simple as that. Now, funny enough, Moody's, so Moody's is obviously a financial institution that does ratings, and they recently warned the Illinois governor that new taxes they're looking to implement will make more residents flee, and Illinois is one of the top states where we have exodus out of the state and less net population come in. I think they're one of the top 3 in the country. So very, very interesting. The state already has a ballooning pension debt and chronic budget deficits. Moody rates Illinois just one notch above junk, largely due to the state's financial situation and malgovernance. So not a great place to be these days, Illinois. Just another side note here, weekly mortgage applications fell 2.5% despite a sharp drop in rates. Purchase volume fell the most. And again, this kind of goes along with what we're talking about here. So rates have been reduced a little bit. The Feds kind of indicate they may not raise them for a while in the future. The design to stimulate the economy and get people buying homes again. But we're not seeing this. We're still seeing people who are on the sidelines who won't buy or going to wait to buy until what they think are material changes in either values or rates. And funny, just before I jumped on the video here, I read just saw a headline for a news article that said, is social media affecting home buying? Well, darn well it is, because we're talking about it here. There's a bunch of other forums out there on YouTube and other locations. People now are sharing information about what's going on, and the sentiment is, I'm not going to buy. I'm going to wait until I feel comfortable on a couple of things hitting, then I can pull the trigger. So I think we will see a decline in values. We'll see more inventory coming on as sellers get desperate. We'll start seeing more price wars. If you're a buyer, hang in there. Opportunities are going to happen. If you're an investor, if you're looking for distressed properties, or if you're just a buyer looking to purchase something at low value, you're going to have more choices as time goes on. Funny enough, the share of Americans who say it's a good time to buy a home increased 4 percentage points in January compared with December. And this is a survey that's come from Fannie Mae. So again, I don't put too much, I guess you could say, weight on surveys from the government, but just as interesting to note that maybe a few more people thought, hey, I like what's happening out there, maybe home buying will be good. But again, that's only 15% of the survey. It's not like it's 50%. 15% of people surveyed said it's a good time to buy a home. That's up 4 points. Think about that. So what I really want to talk about today was something from ATTOM Data Solutions. They released their end of 2018 home equity and underwater report. So we're talking about the fourth quarter of 2018. Now we have 14.5 million properties in the US that are considered equity rich, which means that when you compare the equity and value of the home to the loan or the mortgage, there's more than 50% worth of equity in that home. So 14.5 million properties are equity rich. That's wonderful. You would think that would make sense after what we've come off a year of high watermark values, etc. So everything seems to be in line. What's not in line, as I turn the page here, which is something I prefer to look at, is the report also shows the underwater homes across the US. Now, they show that there are more than 5 million properties that are seriously underwater across the US. Now, not just underwater, but catch the term seriously. Seriously means more than 25% or greater underwater. So what that means is that your home's market value or appraisal is $100,000, but you owe more than $125,000. So there's a disconnect there with your value to what you owe. So 5 million plus properties in the US are still underwater. So that's just because the values aren't there. Maybe they never recovered from the last housing crisis. Now, if I go back to the last housing crisis, you know, back when they actually started looking at this information. If we go back to Q1 2012, about 12.5 million properties were underwater. So that number every month, every quarter has gone from 12.5 million and it slid down, which would seem to make sense. The number of underwaters will drop as home values will rise. Well, we kind of plateaued for 2018. So it was dropping, and then in one quarter, I think it was second quarter 2018, it actually spiked up again. So it increased, and we had another drop in the third quarter, and now we're up again. Well, we actually are still over 5 million, a small insignificant drop in the fourth quarter. But the point is, we have 5 million plus properties that are underwater, and that number has pretty much remained constant over the course of 2018. So when we've hit our most high value since the last housing crisis, we still have 5 million properties underwater, which is, to me, doesn't quite make sense, but it is what it is. What that means to all of us, I guess you could say, is there's pockets of locations that never recovered from the last housing crisis. There are people who are stuck in their homes. They can't sell. If you're underwater, if you want to sell your home, you either have to bring cash to the closing table and pay that difference of loan balance of what you owe, or you become distressed and do a distress sale as a short sale and have the lender write off some of that debt stuff that you owe. So that's your options if you think about it. Not a heck of a lot going on there. So 5 million people homes still underwater, which I think is a pretty big number. If we take a look at some of the locations where we see this is trending upward, there's states with the highest share of mortgages that are underwater include Louisiana at almost 21%, Mississippi almost 17%, Arkansas almost 16%, Illinois 15.6%, Iowa 15.2%. If we delve a little deeper at some of the cities, Baton Rouge 20.7%, Youngstown, Ohio 19%, Toledo 18%, New Orleans 19%, Scranton, Pennsylvania 17.7%. So you've got states that have a high percentage of underwater. You've got metro locations with a high percent. And believe it or not, there's 27 zip codes across the U.S. where more than half the properties are seriously underwater. And again, those zip codes are located in either Chicago, Cleveland, St. Louis, Atlantic City, Detroit, Virginia Beach, to name a few. So you've got states with issues, you've got cities with issues, you've got zip codes that are concentrated with issues. So what I would do if I'm an investor, I'd go looking for distressed homes in those zip codes if that was your opportunity. So now states with the highest share of equity-rich properties are California, of course, with almost 44% equity-rich. Hawaii, almost 40%. New York, almost 35%, Washington, almost 35%, and Oregon, almost 33%. So we're going to see the highs and we're going to see the lows. It's just nature of this ball game. Funny enough, everything is West Coast. Well, not everything is West Coast. Hawaii, New York, Washington, Oregon. So a little distribution there across the country. But, you know, we know that we're not surprised by the states that have the most equity-rich property. Simple as that. 7 out of the top 10 equity-rich counties reside in California. There's no shocker there, that's for sure. So, again, just be aware of what's going on in the marketplace. We still have, you know, a divergence with respect to values, underwater, things like that. I believe that we're going to see more underwater properties. That underwater value will increase as the quarters go on. Reason being, more inventory, more price reductions, more lower sale prices. We're going to see that happening now. So, you know, the December statistics, you know, October, November, December is based on closings. Doesn't include all this new inventory that was on the market that came out in November, that came on December, that's going to come on in January. Okay, so all the stuff that comes on now relates to future closings as time goes on. That's where we're going to see decrease in values, a lot more inventory, a lot more choice, a lot more stuff going on. So that's the scoop. Just interesting to note that the underwater number really is not changing. My expectations, I said, it will change. The underwater number will increase as time goes on. And the reason being, more people over the past year took mortgages with lower down payments. So mortgages from non-banks are the big mortgage originators over the past couple of years. A lot of the mortgages that were issued worth low, like 3% down mortgages. So you took a mortgage, say, in November, and you put 3% down. And now we see, as time goes on this year, there's some shifting in values. Well, if you lose 5, 6, 10% of value, you're upside down your mortgage. You add closing costs and commissions if you sell, now you're 15% in your mortgage, okay? So that's how things change. So we're going to see a lot more of that taking place. And again, the reason being that when you see that underwater has plateaued, it's because there's more, you know, smaller equity mortgages being originated out in the field right now. So little value differences will cause that to tip the other way. Simple as that. So anyway, that's a scoop for today. I'll try to get another video out early next week. What I haven't spoken about is foreclosures for a while, so I'm trying to look for some data on that, and that'll be telling when we come off some of this underwater stuff here. So once again, look forward to speaking to you next week. So thank you for the views, likes, and the comments. If you're looking for more information from me, please send me a direct email. My information's there in the body of the information part of the video. So if you like what you hear, please subscribe. I always love to have more subscribers. And again, I'm always able to talk about purchases, opportunities, where the market's going, investment opportunities, etc. So again, thank you for watching, and we'll look forward to talking to you early next week.